Hi, my name is Jim Francis and welcome to M2 Spread. Like many of you out there, I worked for a living for many years, and as I spent that time working for a Fortune 500 company, working 40, 50 hours a week, I kind of fell into the trap of what I call the 40-40-40 plan. The 40-40-40 plan basically means you work 40 hours a week for 40 years, only literally to take a 40% pay cut at the end of that time. Fortunately for me, I had a number of mentors in my life, and one of those mentors very early as I was working in that Fortune 500 company was a guy named Jim Rohn. And Jim said, if you work hard on your job, you make a living. If you work hard on yourself, you make a fortune. And I took that to heart. When I say I take it to heart, I spent over $81,000 on books, tapes, and education to improve myself in real estate business and the stock market and asset protection and taxes. And as I spent that money, I mastered some certain skills. One of those certain skills were some skills about the stock market. In fact, I had many stock market mentors. In fact, some of those mentors were some of the best folks that are out there. It doesn't matter whether it was WiseTrade or Option Addicts or Profit Strategies Group or Teach Me to Trade or The Pit or Star Trader or whatever that might be. And even some great mentors, like the person I'm standing beside right now, Sir John Templeton. All of them gave me great insights, great strategies, to improve my trading. And that's what I'd like to do in this short, brief session, is to give you some insights and maybe give you a perspective shift which can make a major difference in your life. You see, most people, in terms of investing, what they do is they have one basic strategy, and that one basic strategy is the buy and hold strategy. Even worse if that buy and hold strategy is combined with another strategy called trust, meaning that they trust that their financial advisor is going to look after them in good times and bad times and get the most out of the stock market. Unfortunately, that isn't the case for many of the stock market investors. When you think about it, most of those investors have just one strategy, and that's buy and hold. Even the financial advisors, their strategy is buy and hold. That's what a mutual fund does. It waits for a stock to go up. And unfortunately in the stock market, stocks can go two other directions. If you think about it, the market can go up, and certainly the market can go down at the same time. Most people, when they want to profit from the stock market, either buy a stock or they buy an option, hoping it'll go up or they're hoping it'll go down. And the problem with that strategy is they're kind of guessing. They're hoping that the market will go up. They're hoping the market will go down. Well, I also know a little bit more about the stock market. In fact, I know when people start thinking about leverage, they start thinking about options. And options can be a great piece to leverage your cash. When you can buy Coca-Cola for $3 an option or a share versus $50 in options or a share, obviously your money goes a lot further. Now, obviously options have risk, and you want to learn a little bit about options and risk and those kinds of things, but the concept is really sound. But there's a little hidden known fact about that. And that is, most people when they think about options think, well, I'm going to spend a little bit of money and I'm going to make a huge amount of money if the market goes up or the market goes down. But what they don't know is that, the market itself, in terms of options, about 80 to 85% of all options expire worthless, worth no money. Well, that means when you buy an option, there's a good chance that it's going to expire worth no money. So obviously that begs the perspective shift or the change in shift to say, well, if there's somebody buying an option, is there somebody selling an option? And if that person is selling an option, why are they selling an option? And that's really the pro. See, the pro realizes that he can be a seller of options, and rather than losing that 85 or 80% of the time, they're going to win that 80% or 85% of the time. And that's a major perspective shift. That's a perspective shift that, can make you a lot of cash in your lifetime. In fact, one of the things we teach is about credit spreads and using credit spreads to be a seller of an option rather than a buyer of an option. And when you sell that option, you actually have money coming into your account rather than money going out of your account. Now, I want to take it a step further. Most people think that, when they're getting into the options play, that they're going to play the market going up or play the market going down. And what I'm going to suggest to you is there is another way to play the market. This is the Russell 2000 in front of me. The Russell 2000, for a period of time has been kind of going sideways, and this is obviously, 2008. But as you can see there, rather than trying to guess whether the market's going to go up or to guess The market's going to go down because it's kind of going choppy and sideways, and you can make money in a sideways market. What I'm going to do is I'm going to take an option position that basically says, or a proposition that says, in the next 30 or 45 days, my proposition is that the market is not going to go below 600, and it's not going to go above 800. Now, how many people would take that option with me, that strategy with me, or that position with me? And I bet many of you are saying, yeah, I would. And why would you do that? Well, if it hasn't gone below 600 in the last 2 years, and it hasn't gone above 800 in the last 12 months, there's high probability that it's going to not go above that point or below that point. And that's really what credit spreads is all about. It's about learning how to take a position at the top and the bottom of an index or a stock, and we tend to use indices more than stock. And when we do that, we earn somewhere between 5 or 10% or 8 and 12% on our money within that 30 or 45 day period. And my personal experience with credit spreads is that you tend to win 11 out of 12 times, 12 months, and 23 trades out of 24 trades. And that's a high probability system. Now, you can also lose quite a bit with credit spreads if you don't know how to manage the downside of the fence. So to fully explore this, what I'm going to encourage you to do is to kind of read through the balance of this material and pick up my ebook. That ebook will actually give you the 7 rules for doing a credit spread. It'll show you how to do credit spreads relatively safe. It'll show you how to do it with high probability and to reduce your risk so you don't lose when you do lose that 1 out of 12 times. This is Jim Francis saying so long for now. We'll see you next time. Thanks. Bye.